And we're going to follow that breaking news. We've got an update on reports that Glencore and Rio Tinto have resumed discussions over a potential merger. Glencore has now confirmed that they are in preliminary talks with Rio Tinto. A merger of both those companies would create the world's largest mining company. So we will, of course, continue to follow these developments for you this afternoon. Meanwhile, last year, gold outperformed major bonds, equities, and cryptocurrencies. How will the price fare in 2026, and should you include it in your portfolio? Let's find out with Chris Louney, Director and Gold Strategist at RBC Capital Markets. Hi there. Thanks so much for joining us.
Thank you for having me. Glad to be back.
So let's just go through some of the key drivers that we saw in 2025 that you expect to maybe continue in 2026.
Yeah, so thinking about 2025, a number of things really propelled gold to these all-time highs. I think from our view, one of the key reasons why gold prices performed and really why investors really started to participate in significant size, particularly through exchange-traded products, really had to do with the pervasive sense of uncertainty. We obviously had a supportive rate environment. There were a lot of other macro factors playing in, but in our view, this level of uncertainty, whether it was tariffs, trade, around the Fed, there are all these types of uncertainties that pervaded in 2025 that I think drew a lot of interest in gold and thus allocations in the space and really drove prices much higher. We saw central banks come in and investors come in, but the macro landscape paired with that uncertainty was quite the cocktail for gold prices.
It's been so interesting. You know, we've seen equities still performing relatively well, but we're still seeing that strength in gold. Usually those two don't go hand in hand. What do you think is going on there?
Yeah, that's a great question, and it's a really good observation because, you know, typically when we think of gold, it is thought of to be a hedge, and so you would imagine a negative correlation there. But we really saw them move together at many points throughout the year. What we saw is that in this world of a risk-on environment, we still saw investors with a high appreciation for this uncertainty and thus still making those hedge allocations. In our conversations with investors over the course of 2025, what historically had been like a 2 to 5% allocation for generous portfolios to gold was really seemingly turning into a 5 to 10% allocation to gold. And we saw that sort of ceiling rise, and that was driven by, even as investors were pursuing performance and risk-on markets and equities, they were simultaneously making those allocations. So we saw those inflows come and prices move at the same time as equity markets really did perform quite well.
It's so interesting, right? And when we talk about uncertainty as a factor, that usually drives the price of gold up. But can you talk about how much of a factor that is with gold compared to like stocks and bonds, for example?
Yeah, it's challenging, particularly because uncertainty is so difficult to quantify, right? But when we're looking at our models and we struggle to really replicate the type of price performance we are seeing at various points throughout the year, whether we're basing that on all of these macro factors, you know, the dollar, unemployment, equities, rates, inflation, all of these factors that you might consider part of a broader macroeconomic model, there's just a significant portion of price performance that was difficult to explain from such a quantitative perspective. And so looking out for these other forms of uncertainty, various indexes, we were able to match some of that price performance. And really it came down to those more admittedly anecdotal, but consistent conversations with investors throughout the year in terms of the reasons why they were allocating to gold. And we even saw similar reasons pop up in central banks. There was the World Gold Council 2025 Central Bank Survey that saw geopolitics as one of the reasons why central banks are allocating to the gold space, not just because of diversification and de-dollarization. And so this driver of uncertainty of geopolitics, whatever we choose to call it, was certainly in place sort of across the broader landscape that is important to gold.
When you're looking at the projections for gold for 2026, like RBC is projecting gold prices to be in the 4,500 to 5,000 range throughout this year, so going even higher than what we're seeing right now. What would it take to get it to that higher range of 5,000?
Yeah, so we do think that gold's going to spend most of its time in that $4,500 to $5,000 per ounce range, but we actually favor the higher end and beyond of our scenario as we get to very late 2026 and into 2027. I think, you know, one of the baseline of our view is that gold will continue, the path of least resistance is for gold to move higher, and that gold will continue to grind higher even with some positive equity market performance that is broadly expected in the market and is expected here as well. But if we were were to get significant risk-off events, that's the biggest upside risk, where gold's role as a perceived safe haven becomes the direct reason for those gold flows. That's where we start to get a significant outperformance even beyond our high scenario prices.
Do you think that that's likely to happen just in the last 30 seconds we have?
It's something that we can't write off. I mean, if we learned anything over 2025 is that uncertainty and unexpected events happen. And I'd argue that 2026, we're already seeing that now.
Okay, Chris Louney, Director of Gold Strategist at RBC Capital Markets. Appreciate your time. Thanks so much for joining us.